Hello, friends. Man, mortgage has been in the news a ton lately. So, we talked about Fannie Mae not having minimum credit scores. It just went live today or is going live today. We talked about 50-year loans, and now they're talking about portable mortgages. So, let's start off first with what is a portable loan. A portable loan means that you could actually take it with you. So, if I get a loan right now and it's a 5%, and I go to buy a new house and rates are, say, 7, well, I can take my 5% loan with me. So in theory, that's going to open up more people to move. It's going to kind of build up this or back out this log jam that's going on in the system. There's also a little bit of talk about assumable loans. Assumable loans is if I'm buying your home, I can take it over at the rate that you have versus getting the rate that's in the market. So again, I applaud all the thoughts and all the efforts towards making the market move. Here's what I'm looking at as a reality of the situation. We're very unlikely looking at portability of loans that already exist in the pipeline. That would take a modification of those loans that the investors are signing off on. There's really not a whole lot of financial benefit to them to be able to do something like that. So I don't know that we're going to see a ton of movement. So we're really talking about the portability of loans moving forward. And then how impactful is that? Because you're talking about the portability of, say, a loan in the mid sixes or sevens when rates are really at an area where they're dropping slightly, but dropping. The other fallback that you get, and when you look at the assumability of loans and taking over someone's loan, is you can only port it or assume it at the balance that it currently is. Home values in the last 5 years have obviously done very well. So, say I bought a home for 400,000, and it's now worth 600, while my loan might only be for 300 right now. So if I'm trying to buy someone's home for 600,000 and assume their $300,000 loan, I still need to come up with a difference of 300,000. And it can't be a regular first mortgage. It's likely to be a second mortgage. The rates are going to be in the 8 to 10% range. So you end up balancing out where it doesn't make as much sense. It also, when you assume a loan, tends to take about 90 days to get that to go through. So it does impact your ability to buy a house because normally a purchase cycle is about 30 days to be able to get in. So it really decreases your purchasing power and negotiating power. So there's a little bit of an impact for that too, which would also happen with the portability situation. If I have the same situation, I have a loan of 300,000 and I'm trying to, if I'm moving from my house, I assume I'm moving to something that's, an upgrade. So say I'm moving to a $700,000 house. In this instance, I have a $300,000 loan, a $700,000 house. I have to come up with a $400,000 difference. So that's why assumability in loans has existed for decades. You don't see it used that often. Now, the people who can use it, say if you're moving down from the Northeast and you have a higher price point that exists there, and you're buying into an area with a lower price point, you might be putting a significant amount down. So that might not factor in for you at all. So, anyway, I think that it's a great suggestion. Do I think that there's going to be a wave of impact for it? Because we're probably not going to see an impact on the rates that are already locked in the pipeline, and because of the timing that it takes to move something like this, and the need to come up with the difference from whatever the loan balance is to the purchase price, we're probably going to see a limited result. But again, applaud the effort. Hope that helps. If you need more videos to understand some of what's going on in the market, click up here and hope you have a great day. Take care, everyone.